Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be answering a question that I get asked all the time, and that is, what is my tax bracket going to be in retirement? So if you've been watching some of the other videos that I have here on the channel, you know I talk a lot about tax planning, and especially tax planning for people that are going into retirement. So one of the most important questions that we need to answer with any tax planning is, what is my tax bracket today versus what do I think my tax bracket is likely going to be in the future? And that's going to kind of give us some direction on a whole bunch of different tax planning strategies, things like Roth conversions and how does my tax bracket change over time. So in this video, I'm going to be giving you some tools and some resources to really kind of answer that question and try to figure out what is that tax bracket likely going to be in retirement. But real quick though, before I get into the content of today's video, if you're watching this and you have some questions or you'd like to learn a little bit more about what we do at Money Evolution, we've got some links down in the description below. You can check out our comprehensive financial and retirement planning called Wealth Vision. You could go to wealthvisionplan.com to learn more about that. And we also have our Retirement Time Machine online retirement planning course as well. And you can go to retirementtimemachine.com for information about that. Or like I said, check out some of the links down in the description below. Okay, so essentially what we're going to be doing here is we're going to be looking at what your tax bracket could be at two kind of key milestones that you're going to come to in your retirement. One of those is going to be your full retirement age, and we're going to assume for purposes of this video here that full retirement age is going to be age 67. And then what we also want to do is we also want to kind of take a look out even further out into the future and see what could that tax bracket be at your required minimum distribution age. Now that's something that just changed here at the beginning of 2023. That could be age 73 for those of you that are turning 73 this year. And then if you're born in 1960 or later, I think that's going to actually begin in 2033, about 10 years from now, that RMD age could go up to age 75. Okay, so now the reason that RMD age is going to be very important to understand is because we want to know essentially if your traditional retirement accounts, money that you might have in 401k or traditional IRA accounts, if that money could potentially grow to a point where those RMDs in the future are going to push you up into an even higher tax bracket. And again, that's going to be part of this whole strategy for understanding what your tax brackets are going to be over time, and that RMD is going to be a very, very important factor to understand. Okay, so let's build out a hypothetical situation here. Let's say that at age 67, you're going to start collecting Social Security benefits, and we'll assume that you're married filing a joint tax return, and we'll assume that for purposes of this example, you're going to get combined $70,000 in total Social Security benefits between you and your spouse. So one thing we know about today's rules regarding Social Security taxation, we know that up to 85% of that Social Security benefit could be subject to tax. So if we just simply multiply 70,000 by 0.85, that's going to give us $59,500. And that's going to be the amount of our Social Security benefits subject to tax. Now, you're going to want to add in any other sources of income that you might have. So if you have a pension, for example, you're going to want to add that in. Let's assume here for just the example that we're working on here that you have a $20,000 pension. So we just simply add that together. So that's going to be $79,500. If you have other sources of predictable retirement income, things like rental income, any other payments that you might be getting, you're going to want to add that in. So here's what we know today is that, again, filing a married joint tax return, $79,500 is going to be your total income that could be subject to tax. Now, if we look at this on some of our charts here, we can see a couple of things here. So I've got the current tax table as it is right now for 2023, and that $79,000, if we look at that, it's going to fall right into this 12% tax bracket. So one thing we do know as well is that you're going to have a standard deduction, or you might itemize your deduction, but at the very minimum, you're going to get a standard deduction, and so for 2023, that's going to be $27,700. So what I did here with this table was created a upper limit of how much total income you have, you can have, and still stay in that 12% tax bracket, also adding in that $27,700 for the standard deduction. So the top of that 12% bracket goes up to $117,000. $24,150. So that gives us a little bit of some frame of reference, but one other thing that we're going to want to know is we're going to want to know what your spending needs are. So if you have, let's say, a spending need of $150,000, now it's going to start to become important of where does that gap come in? Where do we get the money for the difference between that $79,000 and the $150,000? So basically about another $70,000 or so roughly is what we need to start looking at taking out of some of the investment accounts. So now it is going to make a difference of what type of account we actually pull that extra $70,000 from. We talked about this a lot in some other videos where we have those three primary tax categories for the different types of accounts: the non-retirement or the taxable investment accounts, the traditional retirement accounts, and if you have any Roth retirement accounts. So if you have some money in, let's say, non-retirement account assets, and I did a video a few days ago where we used some numbers here, and we said hypothetically we had $300,000 in some non-retirement accounts. So you could effectively pull that $70,000 from the $300,000, and depending on if that money's in cash, you could just pull that out, and it's not going to actually raise your tax bracket at all by just pulling money from your own account. Even if you had to sell some investments, if they were long-term capital gain investments, you would be taxed at a tax preference rate, and so that would not, in other words, go onto your income tax base. So that wouldn't actually push you up into a higher tax bracket, even if you had $50,000 or $75,000 or $100,000 of long-term capital gains. So that's going to be a tax preference item. So again, that's going to matter where you pull that money from. We're going to assume for purposes of this, again, we did this example very similarly in a different video where we were talking about some Roth conversions and things like that. But let's say we have $2 million in a traditional account. Let's say we have $600,000 or so in a Roth. So the other thing we can kind of extrapolate from this and say, okay, well, yes, maybe you can get by for a couple years, stay in a very low tax bracket, but eventually this money is going to run out. And I think that would probably be fairly common for most individuals, that most people that we see, at least with our financial planning, tend to have the bulk of their retirement savings in these traditional retirement accounts. And so at some point, for I would say the vast majority of financial plans that we do, we're going to see that non-retirement account run out, and then you're going to be pushed to taking that money from traditional. You could also take money from Roth, but again, like we're going to talk about here in just a little bit, what is this traditional retirement account potentially going to grow to by the time you get to that required minimum distribution age? So if we come back here, and we use our same tax reference guide. By the way, this is something that we have as a part of our Retirement Time Machine course. We have a lot of great materials, a lot of great worksheets that kind of walk you through all of that. So just kind of a shameless plug there in the middle of our video here. But now if we said, okay, we need $150,000, now that's clearly pushing us up into that next tax bracket, which actually would go all the way up to $218,000. This is the Tax Cuts and Jobs Act rates, and these rates, we've talked about it in other videos, but they're set to expire at the end of 2025. So we only have a couple years left, and then what we have here is, for reference, I created a new tax table that is basically showing what would happen if we revert back, or when we revert back to the old tax table that was back in 2017 before this Tax Cuts and Jobs Act rates kick in. And now we can see married filing joint, if we need $150,000 of income, that's going to actually be in this 25% tax bracket. So again, that's one of the things we talk about with a lot of our tax planning is what is my tax bracket today versus what do I think that tax bracket could be up in the future. And we also see too is that under the current tax rate, this 24% bracket for a married filing joint goes all the way up to $391,000, and we get to the 28% bracket at $293,000. So basically, you could have an extra $100,000 of income under today's tax brackets and still be in a 24% bracket instead of that extra $100,000 being actually in a 33% tax bracket. So that's why when we talk about doing Roth conversions and some of the tax planning strategies, that's why we say for a lot of people that 24% bracket is really going to be sort of the sweet spot where kind of capturing some of the room that you might have in the bracket up to that 24% is probably something that could be a good strategy for a lot of people. Okay, so next what we want to do is we want to look into the future to see, is the money that we have in these traditional retirement accounts, is that money going to potentially grow to a point where we might be pushed up into a next tax bracket? And the way we're going to do that is I'm going to basically use a financial calculator to kind of do some forward-looking projections. So for purposes of this, we're going to assume that you're 67 years old and you essentially have 6 years until those required minimum distributions kick in. So we said that you have $70,000 of Social Security benefit. We're going to assume some inflation factors on this. So using a financial calculator, I already calculated this and I said, okay, in 6 years, you're going to have, let's say, $80,893. And of course, these numbers we don't know for sure, but Social Security does have a cost of living adjustment. So depending on what inflation is, that number may go higher or lower, but we're keeping it consistent. Here I'm using a inflation factor of 2.44%, the same financial planning inflation rate that we do for our financial plans in there. So $80,000 from Social Security. We also said we had a pension of $20,000. It is common to have a pension that does not have a cost of living adjustment. So, there's some government pensions and things like that that might have a COLA, but we're going to assume here that you do not. So basically adding those together, it's $100,893. And then if we also take a look and say, okay, we might have a standard deduction still. We're going to assume, because in 6 years, the current Tax Cuts and Jobs Act rates will expire, so we're going to go back to that little bit lower standard deduction, as well as having some personal exemptions, which were something that was taken out with the Tax Cuts and Jobs Act. But we're going to assume this number happens to coincide or be coincidentally very similar to what we have today, but $27,777 is what we would basically forecast the standard deduction for a married filing joint tax return. And so if we subtract that, it gives us $73,115. Okay, so $73,115, that's going to again be the amount of future projected taxable income 6 years from now out into 2028. And again, that was assuming that we inflated that Social Security amount that you're getting, as well as taken out a standard deduction that's also been inflated for inflation. So if we look out to our estimated future tax rate table. This is something we created as a part of the Retirement Time Machine course. We can come over here to 2028 and we can see where sort of the upper ends of those tax brackets might be. Again, this is just an estimate, so actual inflation and actual numbers out into the future are yet to be determined. But according to this, we look at the 25% tax bracket as an example, we could have $199,591 of taxable income and be in a 25% tax bracket. Or if we wanted to look at a 15% tax bracket, I'm not sure how possible that would be, but that would be taxable income of $98,948. So just to give us sort of a little bit of a reference here. And then if we came back over here and we started doing some math on this, we can then kind of look at where that upper end of the bracket might be. So 199, so we'll look at the 25% bracket first, so 199,591. And then what we want to do here, very simply, is we want to subtract that $73,115. And that gives us a number, 126,476. Okay. And now what we can do is we can kind of work some math backwards and say, okay, well, at 6 years from now, basically that's going to be when our RMD age is going to kick in. If we divide that by what our first year's RMD is going to be, and again, it's a divisor, so the first year RMD for an individual is going to be 26.4 for age 73. That works out to be 3.77%, so we divide that by 0.0377. We get a number, 3,354,000. If we want to be exact, 801. So what that tells us is that gives us an idea of what the maximum amount of that traditional retirement account could be at age 73 for when those RMDs are going to kick in. So that gives us a little bit of a target. And if we're under that, all things kind of being considered and some hypothetical looks out into the future, we would then be able to maintain that 25% tax bracket. And if we wanted to continue this and look at, okay, let's try to target the 15% tax bracket, we're essentially going to just do the same math there. So we're going to take our upper end of what we would project that tax rate to be in 2028, so $98,948, and then we're going to subtract out our $73,115, and that's going to give us $25,833. And so essentially, what we're doing here is we're saying, okay, we need our RMD to be $25,833 or less in order to not get pushed up into that next tax bracket, which, again, if we revert back to what those old tax tables would be going from a 15% tax rate to a 25% tax rate. So when we divide that by that 0.0377, we get 685,000. So the question that we would really have here as we start to do some tax planning is it feasible for us to get that retirement account down to something under $685,000 so that we could stay in potentially a 15% tax bracket? Well, I can tell you for sure, one of the things that's going to be necessary is it would be necessary to, at least for right now, to basically push your income up into the 24% tax bracket under the Tax Cuts and Jobs Act rates, or probably the 25% tax bracket in that period of time, those 3 years between you have left basically after 2026 through 2028 effectively. And if you could target that, you could potentially bring those incomes down for what those required minimum distributions are going to have an impact on your income. Okay, so now let's start to look at some potential strategies that we can use to try to get some of those required minimum distributions out into the future below maybe that threshold, that 25% threshold, or maybe even the 15% threshold. And we're going to do this through a combination of taking some withdrawals from our retirement accounts, from those traditional accounts, as well as maybe some Roth conversions. So one of the things we want to look at here is we know that from earlier when we were looking at the hypothetical situation that we needed $150,000 of income. That's just to kind of do what we want to do in retirement. What we also want to do is we're going to look out and we're going to say, okay, based on today's tax table, if we wanted to target, let's say, the 24% tax bracket, we could have up to $391,900 of total income. And that's, again, after we've already deducted our standard deduction from that. But the other important thing here is this total tax. And so that's something that, again, we created as part of this reference guide right here. So $74,208. And so if we just simply add that together, so now our need is how much we need to spend, but we also need to factor in those taxes. And here what we're doing is we're targeting that 24% tax bracket. So this is going to be $224,208. And so now that is our new need after we've now accounted for taxes. So again, that's going to be our new need after we've accounted for taxes. Now, what we also talked about earlier is we know we've got some Social Security benefits coming in, and we also have a pension coming in as well. So we said $70,000 for Social Security, and we also have a $20,000 pension for a total of $90,000. And so that's money coming in from those predictable income sources. So if we subtract that, that brings that down to $134,208 is going to be the need that we're going to have to withdraw from some of our investment accounts. Now, there's a lot of different ways that we could take a look at doing this. One of those is we've got some money in that non-retirement bucket. So you could just simply withdraw all $134,208 from that non-retirement bucket. What I'm going to do is just to kind of keep things a little bit simpler, I'm going to assume that here over the next 3 years, we're going to withdraw $100,000 from that non-retirement bucket. We're going to assume also that that money's in cash, that we don't have to sell anything to get that. And that's going to mean that we're going to have a need from the portfolio of $34,208. So that's going to be the amount that we're going to have to take out of the IRA account to make up that difference for our spending need. Now, one of the other things we've been talking about is how do we bring down the values of that traditional retirement account so that our RMDs out in the future are going to be a little bit less. So again, we want to target that 24% tax bracket, and so if we add in our standard deduction to that 24% tax bracket, that means we can have $391,900 of total income coming in and still be just in that 24% tax bracket. We talked about the Social Security benefits only being taxable up to 85%. So even though we have $90,000 coming in, not all of that is going to be taxable as income. So we said that number earlier was $79,500, and so that's going to be the taxable amount of the pension and also the taxable amount of the Social Security benefit. So that's going to give us $312,400, basically room left in that 24% tax bracket. We know we're taking a withdrawal because we do have some needs. We want to be able to spend that money in retirement. So that was $34,208. Okay, so that's our IRA withdrawal. And if we subtract that, we get $278,192. And so what is that number? Well, that is the amount of room we have left in the tax bracket. So if we want to fully take advantage of that 24% tax bracket, this then can be a Roth conversion. And what we're going to be doing effectively is moving over a total, or basically taking a withdrawal of $312,400 from our retirement account through a combination of taking a small withdrawal to meet our spending needs and then doing a very large Roth conversion. And we're going to be doing this over the next 3 years. So now knowing that, we can then calculate what the value of that traditional retirement account might be in 3 years after we've taken advantage of those Roth conversions and that withdrawal. Now that also kind of coincides directly with when those Tax Cuts and Jobs Act rates expire. So we have 2023, 2024, and 2025. So it just so happens that we're using up that $300,000, $100,000 each year to kind of supplement some of our needs, and then doing those large Roth conversions over these next 3 years. So we said earlier that we have $2 million in a traditional retirement account. And if we do some math using a financial calculator, we're going to assume a 5% rate of growth. Some of you may think that may seem a little bit low. We like to be a little bit more conservative. I think the other thing that we want to keep in mind too, something we've talked about in other videos, is how you do your asset allocation across those different retirement tax buckets, or those tax buckets basically. So your traditional retirement accounts generally should be invested a little bit more conservatively than, let's say, your Roth retirement buckets, because two things. One is that's going to be the money that we're typically going to start tapping into first. So we want to think about how that's going to play out in terms of managing your cash flow, but also two, anything that those traditional accounts grow to means additional taxes that you'll have to pay on that. Whereas if you're growing faster, hopefully in a Roth IRA account, that's all going to be tax-free. So we're going to assume 5% growth, and then we're going to assume, again, that you're taking out that $312,400, double check that, and that's going to be your withdrawal. So if we run that through a financial calculator at 5% for 3 years, we know, based on that assumption, that you're going to have $1,330,409. So now we're starting to get a little bit closer to those numbers that we were talking about, trying to get under that 25% tax bracket. Well, obviously, that's way under that. And then also, we're getting very close to possibly getting under that 15% tax bracket as well. Okay, so now let's continue this for the next 3 years, or basically the last 3 years that we have until our required minimum distributions kick in. So we know that we still have that need of $150,000, and I'm trying to keep things really simple here. We do know that there's probably going to be some inflation on that as time goes on, you may need more than $150,000 to keep up with inflation, but we'll keep things relatively simple for now. And then we also know there's going to be some taxes. So if we kind of go out to our tax table, basically, that has the rates before the Tax Cuts and Jobs Act that have been adjusted for 2023, we can see that the 25% tax bracket goes up to $20,963, but also has total tax of $34,383. So we're just going to keep things reasonably simple here, and we're just going to say you have $35,000 in taxes, and if we add that all together, we need $185,000. Okay. We know we have some money coming in from Social Security and from a pension. Again, that Social Security benefit may also grow a little bit with inflation, but we're going to say that it's going to stay at that $90,000, which means that if we subtract that, you now need $95,000 to essentially pull from some investment accounts. That's going to be our gap that we're going to have between the money that we have coming in from those predictable income sources and then the amount that we're going to have to withdraw from the portfolio. Okay, so now if we assume the upper end of that 25% tax bracket, we're going to just round off here a little bit, we'll say is $200,000, so that's the upper threshold before we go into that next tax bracket. And then we know we have some taxable income. We said 85% of your Social Security benefit could be subject to tax, and then that $20,000 pension, so that would be $79,500. And we're going to subtract that, and that's going to give us $120,500. And basically what that is, that's the amount of room that we have left in that 25% tax bracket. We know we have a spending need of $95,000. So that was what we just calculated a second ago. And so that means that we have a gap between the upper threshold of that 25% tax bracket and after we've taken our withdrawal, so that's going to basically be our IRA withdrawal there. And we have, let's see, $25,500. And so that difference is now the amount that we can still do as far as a Roth conversion and still be in just that 25% tax bracket. So we're taking basically a total of $120,500 out. $95,000 is just to cover our living expenses and needs, and then $25,500 is going to be a Roth conversion so we can fully maximize that bracket. Okay, so now what we can do is now we can calculate where that traditional IRA account would be projected to be at the end of that entire 6-year period, basically when your RMDs would begin. So we said basically after the first 3 years, because we were doing a more aggressive Roth conversion and drawdown, we were able to get that traditional IRA balance down. I'm going to rewrite that number to $1,330,409. So that's going to be our starting value. And now we said here just a second ago, we're going to be withdrawing $120,500 per year. We'll assume the same 5% growth rate on that portfolio. And so as we do that, if we calculated all that, we're going to have $1,160,238. So that would be basically the RMD age traditional IRA or retirement account, basically. So we didn't quite hit our mark. So if you remember back just a little while ago, we actually said that we would need to get under about $685,000 to be able to stay in a 15% tax bracket, assuming all of these other assumptions and everything. So we didn't quite hit that, but we did make, I think, some very, very significant progress towards shifting some money over from traditional retirement accounts over to Roth, basically with the understanding that, we're in a little bit lower tax bracket while we're doing some of those conversions and taking some of that drawdown of what we think those tax brackets are going to be in the future. So 24% versus 25% isn't really all that significant, but even though we didn't quite hit the mark there on what that RMD total IRA balance needed to be to get under the 15%, it does reduce greatly the amount of tax that we're going to be paying at that 25% tax bracket. Plus, something we've talked about in a lot of other videos, there's always the possibility that tax rates go up more in the future, and so this is giving us some protection against that. We're doing this as a married filing joint case study, but let's say something happens and you or your spouse pass away. Well, none of this is really going to change too much as far as the amount of money that you have in those IRA accounts, but going from a married filing joint tax status to a single tax status just means that you're paying higher tax rates at lower levels of income. So this is going to have a lot of, I think, future benefits to doing this type of strategy. So we know using this hypothetical situation and this strategy, we've been able to reduce the amount that was in those traditional retirement accounts from about $2 million to $1,160,000. But what about the Roth? What happened to the Roth assets? Well, we started off this case study basically with $600,000 in the Roth IRA account. And what we know is a couple of things. We know that during the first 3 years, we were actually moving over $278,192 into that Roth IRA account. So we'll say $278,192, and we did that for 3 years. We're going to assume that the Roth account is going to grow at the same rate as the traditional retirement account. That's typically how we do our case studies when we're doing our comprehensive financial planning, so we can just kind of isolate the tax benefits of doing these Roth conversions. But as I mentioned earlier, in reality, we're probably going to want to invest that Roth money a little bit differently than we're doing the traditional retirement account. So it's very possible or hopeful that maybe that Roth account is going to grow by something greater than 5%. But we're just going to use 5% here, and we're going to say, okay, we started with $600,000, we added $278,192 for 3 years. That brings that up to $1,571,000. So we're seeing some pretty good progress, 571, 575. And again, this is using a financial calculator. And then over the last 3 years, because the tax rates are assumed to go back to what they were previously to the Tax Cuts and Jobs Act rate, we're only converting $25,500. And so we're going to assume 3 more years at that at the same 5%. And then that brings us up to $1,899,000. And I guess to be specific, $683,000. So that's making some very significant progress. We've actually 3 times the amount of money we have in Roth, and we've also reduced significantly the amount of tax exposure we have in that traditional retirement account. So you kind of get an idea here. So we started off the video basically talking about what is my tax bracket going to be in retirement. We ended up getting into a little bit of a case study here, but I hope all this has been helpful. So again, we have some great resources. We do the comprehensive financial planning where we use computer software to kind of map all of this stuff out. But in the Retirement Time Machine, we've got some great resources where you can really kind of dial this in and really see, where are you at today? Where are you going to be in the future with different tax strategies? We've got some worksheets. One of them is exactly kind of what we walked through here called How Much Can You Convert to a Roth IRA, where we're kind of walking you through step by step that entire process that we just kind of went through. So I know this was maybe a little bit longer video, but thanks for sticking with me. I hope you walk away with some great information and an idea of how these strategies work. And again, if you want to learn a little bit more about what we do at Money Evolution, check out some of the links down in the description below. Be sure to hit that subscribe button to our YouTube channel. It's a great way to let YouTube know that people are watching the videos, people like what we're doing, helps to get us exposure out to a whole new group of audience and everything. So anyway, with that, have a great rest of your day, and I look forward to seeing you back in one of our next videos. Thanks.